You're listening to the All-Star Charts podcast with JC Peretz on technicalanalysisradio.com.
All right, everybody, we are back on the podcast, and I am very excited today to have Willie Delwiche on the podcast. Willie is the investment strategist at RW Baird. Willie, thanks for being here.
Yeah, thanks, JC.
So I've been following your work on Twitter and social media. You have both a CMT designation and a CFA designation. Why don't you maybe introduce yourself to the audience? Maybe talk about a little bit about what your day looks like.
Sure. So yeah, I've got in addition to CMT and CFA, I also have a educational background in economics. So I like to tell people I can talk as high level or as low level as we want to. Doesn't necessarily mean I know more. It just means I feel like I'm slightly more equipped to talk about it maybe. In terms of the day-to-day, my role at Baird is to generally support our financial advisors. We've got about 1,300 of them now, and that's supporting them through written material, supporting them through comments that they either call me about or email me about, doing presentations for them. And then the other side of that too is I manage some ETF portfolios from kind of a tactical perspective, and so managing those for financial advisors for their clients as well. And so a lot of the day is probably not too dissimilar from other people. You get in and you update the data and you see what's going on, and you try not to get dragged into the weeds too much and keep some perspective and try to really figure out what's the news of the day, what's the noise of the day, what are the important things that are happening today, this week, this month, and perhaps going forward.
A couple of things that I like that you do, some of the indicators work that you publish or that you write about. Why don't you talk a little bit about maybe breadth thrusts and some of the stuff that maybe you've been seeing recently and how you sort of approach that particular signal?
Sure. So just to step back for a moment, I think it's a very important thing to keep in mind for all of us is that we need to be really disciplined in how we approach the market. We can't just be swayed by this news item or that indicator. We'll get swamped by it and we'll lose all context. And so we at Baird we do that through what we call our weighted the evidence approach. We've got some fundamental indicators. We've got some technical indicators that we kind of keep track of. They give us a sense from a risk management perspective of should we be leaning in towards equities? Should we be leaning out towards equities? So that's the backdrop. Specifically to breadth, which is one of the kind of the buckets that we look at. There's a couple different ways that we can think about breadth. I know the advanced decline lines are very popular. I'm personally not such a big fan of them. We could get into that later if we really wanted to, but from specific to the breadth thrusts, this idea, and it's been evident over time that when you get a whole lot of buying pressure or a whole lot of short-term participation in the market, that tends to create, if you will, some momentum in the market, that you have strength that persists over time. And one of the interesting things we've seen this year, after not seeing breadth thrust for a couple years, early this year, we saw breadth thrust in January. That was a suggestion to us that maybe the worst of the decline in December was past us. And now, more recently, as everyone's gotten caught up in the headlines of, we're seeing this rotation, we've lost leadership, those sorts of things, beneath the surface, what we've seen is actually better participation. We've seen some breadth thrusts reemerge. What I'm particularly encouraged about is that we're seeing evidence overseas as well that maybe we're going to get some overseas breadth thrusts. And so while the headlines say, okay, well, we're not making new highs on an individual stock perspective, beneath the surface, it looks like more and more areas of the market are starting to participate. And that's kind of the idea behind breadth generally. And we're getting to the point that maybe maybe we can have some sort of I don't know, a self-reinforcing upside momentum emerge in terms of the broad market.
So while I agree definitely that we're getting more participation, and I think the sector rotation is not negative. I think it's positive.
Yeah.
How specifically do you define breadth thrust? It could be defined in a lot of different ways. How do you look at it?
My preferred way of doing it, and it's not the only way. I like to look at advanced decline ratio on a 10-day basis. So it's the 10-day sum of advancers divided by the 10-day sum of decliners. And when that gets to be about 2 to 1, that's when you get the breadth thrusts. There's other ways of doing it. You can look at the percentage of stocks above their 10-day averages, percentage of stocks above their 50-day averages. I like the advanced decline ratio in part because it's given the best signals from my perspective. It's got a long history, and it's been right way more often than not. And so that's my preference is that particular measure of it. I would caution, and I'm sure you do this, JC, is you can't just jump from one indicator to the next and say, well, oh, this one's providing a signal now, so let's chase that one.
No, the way to do it is that you have to first figure out what your narrative, what you
yeah, exactly.
And then you have to find the indicator that fits that narrative. That's how to do it.
There are a lot of advantages to the world we live in right now in terms of the availability of data. That is not one of them. You can jump from thing to thing to thing, and like all you're doing is you're finding the thing that supports whatever you wanted to begin with. And so,
am I doing it right?
Yeah, not doing that is like the first thing is don't jump around.
That's hilarious. Okay, how about this? I got one for you, Willie. Okay. What about talk to me about the value line indexes. I know you look at them. I know you like to talk about them. I have my feelings. I talk to my friends about them. How do you feel about these things? Geometric, arithmetic?
Yeah. So I'm a big fan of the geometric index. I'll say that. I think that gives you a better sense of what's going on than just looking at, say, the S&P 500.
Right.
And the reason for that is you're catching from the value line geometric index perspective, you are catching what the median stock is doing. You're not getting swayed by a handful of stocks, whether it be the FANG stocks more recently or at other periods in the time where you've had just a few stocks going. You get I think a broad measure. It's like 1,600 stocks or something like that. So you've got large caps, you've got small caps, you've got mid caps. It gives you a broader sense of what's happening in the market. And I would also say that the lack of attention paid to it, I think, makes it a little bit more useful because it's maybe not getting swayed by a lot of attention. And so I think right now the S&P 500, for example, that's where the emotion is. That's where you have fast money come in and come out. You have but whether it's via ETFs or via options or via futures, I feel like there's a lot of noise happening in the S&P 500 right now. You step back to something I don't want to say more obscure, but maybe a little bit more isolated from that, and I think it gives you a good sense of what the median stock is doing. And I think it's much more important to pay attention over time to what the median stock is doing, whether it be in terms of performance or in terms of valuation, than just what a headline index is doing. So the quick and easy answer is value line geometric index. A very big fan of it. Find it very useful. Keep an eye on it because I think it's a useful indicator of what's happening beneath the surface.
All right. So then what about the sentiment indicators? Is the idea to figure out what
Yeah.
data you're looking for and then pick the sentiment indicator that's backing up that thesis? Is that
Yeah, that's exactly. I mean, you have got it nailed. And the nice thing is there's so many of them. Someone's always bullish, someone's always bearish. I yeah, I would say first of all, the signal from sentiment most of the time is noise.
Yeah.
You're not getting something, and you could even say one step further, and this is an NDR adage. You go with the crowd until you reach an extreme. So everyone thinks, well, you see a sentiment tick one way in the middle of its distribution, so you automatically lean the other way. No, that's only if you're at extremes. So that's kind of the first caveat is that there are important signals from sentiment. Most of them, or most of the time, sentiment isn't giving an important signal.
Yeah.
In terms of the ones I like the Investors Intelligence Survey. I don't like the AAII survey. It's a handful of people, and it seems like when things go down, and it seems like you're getting a more bearish response. It's just more people are responding. So I think there's some issues there. Even better than either one of those are composite indicators. There's a daily trading sentiment composite that NDR produces on a daily basis that has a great track record of identifying extremes. And then if you're not a trader, if you want to step back and think about things maybe from a weekly perspective, then you can look at, they have a crowd sentiment poll, it's the same idea. It's the sentiment surveys, it's the VIX, it's the put call ratios, kind of put together in a reasonable, somewhat rigorous way that keeps some of the indicator chasing out of it. So those NDR indicators are good ones. The other thing I like to do is watch flows. Are people rushing into equities? Are people rushing out of equities? That gets a lot of attention. What we're seeing right now in September, for example, is this rush into equity ETFs, and so it suggests to me, we've got some good things going beneath the surface, but people are also getting pretty optimistic right here.
So when you look at flows, you would look at that from a contrarian standpoint. So you're saying, okay, so sentiment has been somewhat bearish, considering we're stone's throw away from all-time highs in most indexes and stuff like that. But what you're suggesting is that's not being confirmed elsewhere?
Well, for most of this year, you've had actually outflows from equities, even though the equities have been rallying, and so you can make a case there that certainly from a contrarian perspective, the rally hasn't been bought. Now you're starting to see a little bit of the opposite of that. I guess, and this is where there's always on the other hand kind of things to our work. You can look at flows, but then you can look at asset levels. And asset levels from a long-term perspective show that people are overexposed to equities, underexposed to cash. And so really it's and there I would definitely look at it from a contrarian perspective and say, well, if everyone's already loaded up in equities, despite what they say they're feeling, they haven't reduced their equity exposure meaningfully.
But how good is that? How good is that for a timing mechanism?
Right. So that's it's not going to catch day-to-day, week-to-week type moves. But if you're looking at things from a long-term perspective and say what does the next 10 years hold for us? Looking at household equity exposure is a very good indicator for whether you should expect returns to be above average or below average. So that's not going to do anything for you from what's going on with stocks over the next 3 months. That's for sure not the case. But in terms of setting the environment, I think that's an important perspective to have in mind is that kind of what's the big picture, what's the environment that we're working in, and then we can drill down to, okay, within that environment, are we seeing people that are super giddy, or are we seeing people that are super fearful, and then lean against that when we see extremes?
What's some sentiment data that you wish you had that you don't, that we can't get, that doesn't exist yet? What's
Oh, um, there's so much of it. I don't feel like I'm short of sentiment data. I feel like if anything, that's a spot where there's too much of it. And then two, then you get you like on social media or Twitter, then everyone is responding just to what they see in their feed about how people are feeling. So this is kind of the opposite of your question. Rather than what would I like to have that I don't have, I'm answering the question of what do I have that I'd like to get rid of. Is the the everyone taking some hot take about how their Twitter feed is feeling on any given day. In the end, it's a matter of self-selection. You've chosen that stream of people to be following, so it may or may not be relevant to anything other than your own observations. So that's my way of not answering your question. Sorry.
No, it's all good. So when you're dealing with the advisor community, right, and they're speaking with households about the market and things like that, are you incorporating other asset classes into those discussions, like energy and precious metals and rates and things like that, or do you stick to the equities?
Oh, for sure. It's a total asset allocation idea that we're thinking about. It's not just, and I think this is where people get it wrong. It's not just stocks or not stocks. It first of all, it's stocks, bonds, cash. I think cash is an underappreciated asset class. Just because it doesn't return much right now doesn't mean it shouldn't be an active part.
Well, cash is returning more than most bonds these days, right?
Right, exactly. Well, and their two gold is returning more than most bonds these days, and so you can think about satellite asset classes like that as well. And so you don't, when I'm communicating with FAs and they're communicating with their clients, or if I'm communicating directly with their clients, only talking about equities is not helpful to them, not helpful to me. It's doing clients a disservice to say, okay, we're going to close off half the world from you and let's only talk about equities. We really need to think about things in terms of all the available asset classes. I mean, we tend to avoid some of the really esoteric ones.
Well, you need at least 15 to 25% for crypto, right? Set aside.
Right, exactly. Well, one of the most frequent questions I get from financial advisors who are getting it from their clients is always a question about the dollar. What's the dollar going to do? Is the dollar going to go up? Is the dollar going to go down? And it's like that's not actually, from my perspective, an important part of your investment process.
Why are they asking that?
Because I think it's because they think that it's important. They feel like that's something that's one that the dollar is either in this always in this massive uptrend or always in this massive downtrend, or that they can somehow take advantage of it. It puzzles me why that is always the question. And the answer is usually, unless you've got business overseas and you have some actual hedging that you need to do because of that business, leave currencies to people that are trading it or otherwise. And I'll step back and say the average Baird client is not day trading their account. That's not the profile of clients that we have, and so you shouldn't be worrying about that. Worry about other aspects of your portfolio. Worry about your equity bond cash mix rather than whether or not you think the dollar is going to go up relative to the yen or relative to the euro or whatever random currency you've come up with.
Well, why don't we talk about that? What I came into the year thinking the dollar was going to get slammed, bullish precious metals. We got to buy them all. Platinum, silver, gold, buy them all. Dollar's about to get crushed. So what's happened? Precious metals have done well. Gold's flat. So I got the trade right, the reason wrong.
It still goes down as a win, though, right? I mean,
the dollar hasn't gone up, right? It's just flat. Dollar index anyway.
Mm-hmm. Well, that's there's a lot of weird stuff going on right now. I'll say that. One of the most fascinating, if you will, weird things that's happening is that dollar flat, gold rallying. Like, that's, a lot of people aren't thinking that should be able to be the case, but it's happening, and so you can't say it's not happening. And so,
is this sustainable though?
I think it is. I think gold is well, that relationship probably is sustainable, but the gold itself, I think the move is probably sustainable. I think you're in the early stages of the resumption of an uptrend.
What I'm referring to specifically is the historic negative correlation between gold and the U.S. dollar, and the fact that the gold has done so well in the face of a dollar that's not falling. Can that be sustainable? Is what I'm asking.
Yeah, I think more important than the dollar relationship to gold is the relationship between gold and rates. Gold historically has done really well when real rates are negative, and so if inflation's picking up a little bit and yields remain low, I don't think it matters so much what the dollar does. Yes, I know that the history between gold and the dollar, but I think the stronger history is gold and relative to real rates. And so then that suggests to me that gold can go up. And then I guess the second question then is, if gold keeps going up, what does that mean for the dollar? And I guess from that perspective, I don't see right now another currency that's going to step up and challenge the dollar, and so maybe it stays flat even though gold continues to move higher for a little bit.
Yeah, because it's interesting. Gold's making new highs in euro, new highs in British pounds, new highs in CAD, new highs in Aussie, right? So in other currencies, gold is doing very well, much better than the dollar because of the dollar strength that we've seen.
Yeah.
So it's a bigger thing than just a dollar thing. So I would agree with you on that.
Yeah. And it's people have been waiting for it, and it's finally, gold bugs are always ready for gold to go up. They're finally getting their day in the sun, and so it feels like there's some momentum to it that could carry it a bit higher from here. I guess the thing that ends it maybe is if all of a sudden we, the kind of the global macro picture all of a sudden becomes much more calm and much more, if you will, historically normal. And you got to be more of an optimist than I am to assume that that's going to happen in the relatively near future. So yeah, I think what's happening in gold, what we've seen, I think it's early stages of it.
Well, you mentioned rates and the relationship there. I mean, a lot of people have an opinion on interest rates. Some have been right, some have been wrong, some were right, then wrong. Are we going negative in the United States?
Oh,
you think that was it?
Yeah, I don't think we go negative. And then part of that, so there's a couple reasons that I say that. One, I hope we don't go negative. And so
that's that's not a good reason.
I know it's not, and I'm just saying that as a caveat because it might be clouding my other reasons. So it's a little bit of that knowing yourself kind of approach to life. Because I don't think negative. There's some people that say, well, it's all a continuum, and if you go negative, it's no big deal. I don't buy that. It doesn't feel right to me. But the reason I don't think we go negative, and I think this is actually kind of important, is that I think the U.S. economy is much stronger than people are giving it credit for right now. And if the economy is stronger than people are thinking, and we've got maybe a little bit more inflation than people are thinking, then much of the certainly recent drop in yields has been, oh no, we're going to recession right away. If that's not the case, then maybe there's room for yields to at least back up a little bit. I don't think we necessarily go to a 3-handle or a 4-handle in the near future, but getting back above 2 would be a step in the right direction in terms of things feeling a bit more normal. I'd also say bonds feel like bonds feel like the really crowded trade right now. And that's where everybody's piled in. Everyone's assuming that bonds are safe, that you always make all your money back, and you always, regardless of what you paid for the bond, you're going to be made whole at the end, and everything will be fine and dandy. And I think that's a reckoning that's coming, that maybe people realize that they can indeed lose money in the bond market. And then there are plenty of people that know that. I'm talking about people that aren't in the market every single day, that look at their quarterly statement and say, wait, why are my bonds down? That could be an awakening, and that could kind of be this pendulum shift that says, well, maybe I don't need quite as much bond exposure as I thought I did if I'm going to lose money there anyway. And just given what we've seen in the bond market this year, I feel like we've pulled a lot of returns forward that are going to have to be made up somehow in coming years. So I don't buy the yields are low on their way to being lower. Feels more to me like the economy is a bit more resilient, and maybe we back it up in yields a little bit, and then we see what happens, see how people respond to that.
So you're in the camp that you're leaning towards that was it for rates, and now we probably either go sideways or maybe stair step higher. You're sort of leaning in that favor.
I think so. I think that would be the approach I would take. And I know what's happening overseas in terms of yields there pulling U.S. yields lower, but maybe, and this is a crazy thought, maybe things in Europe aren't as bad as people are fearing any more than things aren't as bad in the U.S. as people are fearing, and so maybe there's a chance for the bond yield to get close to zero, and I mean by that I mean move higher, and so then that relieves some of the downward pressure on U.S. yields, because there's a lot of people now saying, well, U.S. yields can't move higher if German yields don't move higher. That there's probably some truth to that, but then maybe the answer is, well, what if Europe stabilizes and yields there move a little bit higher, and then our yields can move a little bit higher?
So you don't think that it makes sense to pay the bank, or in this case, pay the government to let you lend them money?
Yeah, well, that's the whole like trying to make sense of negative yields. Like, why would you buy one of those? Like, I don't understand. I don't understand why cash isn't a better alternative than negative yielding bonds, but maybe I'm not a sophisticated enough fiduciary kind of, asset liability matching banker or something. I don't know, but no, negative yields do not make sense to me.
Okay, what about when we talk about the curve? I mean, you've done the work. You're a historian just by the nature of what you do every day. So yield curve inversions are historically buy signals for the stock market, are they not? Depending on your time frame.
Yeah, right. Depending on your time frame. That's a funny thing. So before and you can get into the which yield curve to look at, whether it's 10s to 3 months or 10s to 2s. But there's a whole lot of and maybe this is just what I noticed, but hold a lot of work before the 10s to 2s inverted, that, oh no, this is awful. This means recession starting tomorrow, if not yesterday. This is the end, da, 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 da. We get the inversion, and all of a sudden there's this whole wave of, well, actually, it means that it's a good thing, and we should have been rooting for it all along, and it's the best news we could have ever had. And so I think the yield curve is I think people are paying a little bit too much attention to it.
The most ever in the history of yield curves.
Right,
Am I wrong?
right. Yeah, and like so many other indicators, the moment everyone starts paying attention to it, the usefulness of it starts to disappear, at least for a little while.
The Hindenburg is my favorite.
Right. If I can't explain it in 15 seconds, it's probably not an indicator I want to pay attention to. And that one feels like it's got way too many. You got to do this, and then you got to do this, and you got to do this, and
great name though.
But it is, and you call it an omen. I mean, you couldn't ask for anything better. The idea of usefulness of indicators, and I think this is something that's happening with sentiment right now, is that so many people are paying attention to it, and I don't think it's like actively gaming it. I don't think it's like everyone like pounding the AI site to get responses in one way or the other, but there's a lot of attention being paid to sentiment right now, and so the usefulness of it more recently has been a little bit less than what it has been historically, and so that's kind of a caveat to people when you notice everyone is talking about something. I'm not saying you get rid of it, but maybe not have that be your top shelf indicator, at least for a little bit.
All right. Well, let's pretend it's a great indicator. Let's pretend it's the greatest indicator of all time.
Okay,
which
sure.
which is the yield curve that we should be watching? 2s, 10s?
Yeah, 2s, 10s. And there's some signal there. It is an indicator of the health of the economy, or at least how the bond market perceives the health of the economy. But with so many other things, you can't just say, okay, this is the only indicator I'm going to follow. You need to. You've got to have a couple other things to go with it. Normally, if the yield curve is sending you a bad signal about the economy, or a signal about bad stuff happening in the economy, you would see it confirmed elsewhere. You would see maybe jobless claims start to pick up, and that's not happening.
How about stocks going down?
Right, stocks going down. That's not happening. So there's, it's so easy to get your indicator that you like, or you think has some usefulness, get the signal from it, and what do you want to do once you have that signal? You want to get attention, so you start waving it all over the place, and you're having this aha moment. It's not like that. I mean, it's not right, and that's one of the things that I think we all need to keep in mind. It's not like, aha, I found my secret formula I've got it perfectly tuned. It's gonna give me that signal, and everything's going to be great, and it's going to be exactly like I thought it was. It's much more of a slapping singles around the infield kind of approach to life than it is going up and trying to hit home runs every time.
I really think that I'm curious in your thoughts on this. While a lot of people think this is a science, and while there might be, or there generally are, a lot of scientific inputs, a lot of quantitative analysis that comes in, we've discussed some already. At the end of the day, the art form is weighing all of that appropriately, and then giving more or less weight to some of that data, and deciding how to do that based on the type of environment we're at the time, right? That's where the art form comes in, no?
Right. That you've hit it exactly on the head. It's not. We're in an environment where everyone's searching for analogs. Like, oh, are we in a repeat of your Hindenburg Omen people? It's 87 clearly.
Definitely 87, 100%.
or is it some other? And every period's analog is itself, because every period is a little different. And so yes, we can learn from history and we can be guided by history. We can't be held hostage in a way that we try to make the present what it was, what yesterday was. And so, I had this a revelation for me. Maybe it's not a revelation for anyone else. I was in the art museum a couple months ago, and I was looking at a Monet painting, some bridge or something, and it's impressionism, and so it's blurry. And but I had my glasses on, and I got really close to it, and you see every brush stroke. I couldn't see what was going on in the picture. I stepped back, took my glasses off, and all of a sudden I could see what Monet was doing there. And I think that's what we need to do. That's kind of the active push that we need to provide. Is we can get lost in the details, and we can over specify and think everything is exactly quantified in some way. But when you do that, you lose perspective, and you don't see, you don't see the overall picture that's in front of you. And that's where the art is having a sense of the picture and not letting the individual brush strokes so dominate your viewpoint that you can't see what's going on.
I couldn't have put it better myself. Willie, why don't you tell the audience a little bit about yourself? When you're not looking at charts, when you're not talking about the market or thinking about the market, what are you doing? You doing a little gardening, maybe?
I love to garden. So I live in the city of Milwaukee, and we've redone our backyard. As our kids have gotten a little bit older, we've taken space from them in the backyard and turned it into more gardening. I love to garden, love to bake bread. That's a great hobby of mine. I think it's one, after looking at computer screens most of the day and kind of dealing with the etherealness of it all, being able to get home in the evening and actually do something, I really enjoy that. And so whether it's vegetable gardening, flower gardening, fruit gardening, got some grapevines that I've planted. We'll see what happens with those. But it's doing stuff with my hands. Really enjoy that. And that's just it's reassuring to me to like produce something, because there's I guess it's a sense maybe that if all I've done is write or think or talk, that's not a tangible thing that I've done. So yeah, and there's lessons too from bread baking, from gardening, that you can plan your garden every spring, and then you see what happens. And some of the stuff you planted comes up and it produces fruit. Some of the stuff that you planted doesn't come up, and so you get nothing from it. Sometimes stuff that you didn't plant comes up and that bears fruit. I mean, that's kind of your dollar gold kind of thing. You kind of planted something, it wasn't what you thought, but you got fruit from it anyway. And so I think it's important to keep an open mind and just kind of see how all these things fit together. The lessons in the market are a lot of the lessons that you can apply in the garden, and vice versa.
I think that's great advice. It's a good way to put it. Sort of seeing, whether it's the bread or the garden, and actually producing something, as opposed to kind of just making opinions and building puzzles, as I like to say.
Yeah.
I do the same thing. When I moved to California, I started gardening myself. I got some eggplants back there, got some watermelon, tomatoes, peppers, of course.
Okay. California is you probably have more fruitful gardening than we do in Milwaukee, but it's also figure out what the environment will bear, and don't try to force something. Like our season is only so long. So what have I learned to do? Plant a lot of greens, because that's what will bear fruit and be productive for us in this environment. I could try to plant watermelons all day long, but probably not going to do anything except get some vines and then be really frustrated at the end of the year.
No, it's funny. When I first moved to California, it was 4 years ago, and everyone was like, "Oh yeah, because I'm a city kid. Like I didn't know, or I
Okay.
was a city kid anyway. I'd never gardened in my life." And they're like, "Oh, it's easy. Any idiot could do it." And you want to know something? Any idiot can do it after all.
Oh, it is. Well, and that's there is, and we could get on a whole the social consciousness aspect of it, but it's good to use your what's around you in a fruitful way. As a father, I like to see my son out there picking tomatoes and just plopping them in his mouth. I mean, it's better to do that than to be inside having cookies or candy or whatever. And that when you've helped grow it as when there's with kids, when you've helped grow it, you're more likely to eat it. So that's it's a neat thing to see, and it's visually beautiful as well. And so I should stop rambling on about about gardening.
No, I couldn't agree more. And it's great, that I got to learn more about you. We didn't prepare for this conversation at all. I just sort of threw out all the questions that I had questions, that I was wondering based on the stuff that you shared and talked about on the stream. So, from the bottom of my heart, it really was a pleasure getting to know you more. I look forward to hopefully meeting you in person in the future out of Milwaukee or New York or even here in California.
Yeah. If you, I know you travel a lot, so if you're ever in Milwaukee, but certainly let me know, and if I'm in California, I'll see if I can't look you up.
All right, ladies and gentlemen, Willie Delwiche, investment strategist at RW Baird. Willie, thanks again for being here, man. Appreciate it.
Yeah, thanks a lot, JC. Have a good one.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.